The amount of debt has just exploded.
For people who are in those significant amount of debts right now,
Yep.
what is your recommendation?
The key part is that you need to know who you're seeking advice from.
Newcomers into the country, what are the top 3 things you can do to make sure you have a great credit going in?
First of all, try to get a secured credit card.
Let's talk about condos. The values have now dropped 25, 30, even more.
Since the start of this year, the one constant word has been uncertainty. With President Trump coming into the mix, it has actually highlighted all of those shortcomings. And now you're looking like, okay, where do we hide? Because you cannot hide anymore.
How does the Smith maneuver work?
The reason why it's called Smith maneuver is because our mortgages are not interest tax deductible on primary residence. So the way it's maneuvered is,
How do you best strike a balance between consolidation and expansion at the same time when it comes to your real estate portfolio?
there's 3 main things that any Canadian homeowner needs and wants. Number 1, number 2, and number 3.
How long have you been here? How long you've been doing this? Where are you from? Anything that you want to share with our audience today?
Yeah, sure. So just talking about the professional side, so I've been in the financial industry for the last 20 years in Canada. Obviously in different roles in different markets within the financial industry. Majority of the time was in the banks. So about 10 years in Citibank. Not exactly into the real estate side, but more on the mutual fund side. And then I moved on to US Bank, where I worked on their hedge fund department. So lots of high net worth individuals and clients, and looking after and doing the services aspect for them. And then slowly and suddenly I moved on to more of the rather than being a number, trying to get into a phase wherein I am my own boss. So I think that being an entrepreneur has its own challenges, but lots of opportunities, right? So then I got into, I took a license for home and auto insurance, REBO, and I worked through that. And then I switched into the mortgage world. So I have a mortgage license for Ontario. And then a couple of years down the line, I also got into a niche product, which is Smith Maneuver. So I got a certification for that. So I'm more into the real estate world now, just like you are. But my main role is, what I say to my clients is anybody can get you a mortgage. But there's only that many people who can actually get you out of that mortgage. So that's what I'm looking at right now, creating wealth generation and getting rid of that expensive debt in your life, which is your mortgage. So that's a little bit about me as to what I'm doing right now and where I've been in 20 years or so. But I am originally from India, part Haryana, and I came here in 2004. So it's going to be about 21 years in May of this year.
And how's the journey been overall, like from, let's say, immigrating standpoint, starting a new life altogether? So take us through that.
It's been great so far. Canada has treated me really well. When I came here in 2004, I was obviously during those times Canada was a lot different than what it is right now. Right now, lots of people who are coming in, they have a good exposure towards the global economy. A lot has changed, wherein you don't really need a Canadian experience to get your first job. But back in those days, you really needed something of a Canadian experience to get into an organization. So I had to start from knocking the doors. So going into doors, knocking and calling for, selling for the gas plans for Enbridge. So I used to knock about close to 100 to 200 doors every single day. And that is you're just going into an area and you're walking and you're basically listening to people cussing at you. Why the fuck are you at my property? Get away and whatnot. And you're in their property. So that was adventurous. It showed me a side of Canada that I never knew existed. It also showed me how multicultural we were, because I met people from any kind of background. And that taught me that, to be in sales, the more doors you knock down, the more opportunities you create for yourself. Because if you were to shy away from knocking that next door, thinking, having a preconception that this person is just gonna, swear at me or he's not gonna let me in, then you would never know what would have happened. So the aim was to keep knocking door, and keep talking and keep scripting, and doing what you want to do to get ahead in life. So I did that for 4 months. Turned out to be really well. And then I got into a good organization wherein I got in a call center job. And from there on, it was just a good linear progression, showing good work ethic. We Indians are really hardworking, and we know as to the work that is provided to us, it should have quality in it, with integrity, and confidence. So that has, kind of made me a more rounded up person right now where I am. Wherein through those hardworking times, through those days wherein people used to swear at you as to why are you at their door, now they want me to close, houses for them.
And buy more doors for them.
And buy more. So now I'm into the wealth generation aspect. So I'm giving back to Canada as well now, do a lot of charity as well as and when I can. And it's been great so far, to be honest, knock on wood.
Amazing. And I think you brought about a great point talking about perseverance, persistence, and grit. And I think all professions need it, but I think salespeople need it more so.
Oh, yeah.
Because as one of my good friends and mentors, Jas Tucker, says, success is going on to the next call or the next door with the same enthusiasm.
That's right.
As the last one, and that too after a no.
Yeah.
So that's great. And you've been doing, or you did something that I have always shied away from doing, which is exactly door knocking. As realtors, as salespeople, we can do 10 different things. Door knocking is definitely not in my top 5.
It is very organic, though. You get to see face to face the person's reaction, and if you are good enough with the passion that you have towards your job, you never know. This could be next opportunity that you never realized.
Right. Great. No, that's great, and thanks for sharing that. I'm sure it must be inspiring for a lot of people out there. But let's talk about the present Canada that we live in, right? That's what I think most people would want more information on. Not that we're already not bombarded with a lot of information from, the news channels and the media, and you have it, social media topping the list there for sure. But when it comes to, I think, the current market, and we see a lot of people have taken on immense amount of debts, something that's becoming a problem for Canada now with 1.2 million mortgages coming for renewal in the next couple of years. But we'll talk about mortgages specifically a little bit later. For people who are in those significant amount of debts right now, what is your recommendation?
Well, that's that's a very important question, because I see that day in and day out. And it baffles me to see as to the state of an average household. The amount of debt has just exploded that people have taken on. And I wouldn't say it's because of the bad decisions of each and every household, but it's a mix of bad politics. It's a mix of economy going sour. It's a mix of what's happening down south right now as well. So all of these things mixed together, it's creating that kind of a mess that is difficult sometimes for folks to get out from unless they deal with a professional. And that's where I guess the key part is that you need to know who you're seeking advice from and from whom you don't seek an advice from. So I see many times people who come to me, they're speaking to their family, they're speaking to their neighbors, and they're deciding based off that. Or sometimes just going on, social media these days. You have so much going on on Insta, on Facebook, on TikTok, that every person kind of these days is kind of a guru of some kind of her own. So you need to really dive deep into as to if you were to go ahead and heed to somebody's advice, where is that person's coming from, what kind of experience they have, and what can they do to assist you. So if I go back to the credit, the issue right now is a lot of people over leverage themselves. And that started from, and it's been happening for a long time and will keep happening, but early 2020s, 21, 22 market was just going crazy. We all know that, the interest rates were rock bottom, almost zero. And people who didn't even want to buy real estate, they wanted to be in. It's being in that group, or being those kind of people who are looking at their neighbor and the neighbor's getting ahead, and they want to do that as well. So a lot of people got into it, took out a lot of equity from their house, or from wherever they could, borrowed money, thinking that prices will never come down, interest rates will never go up. But we all know what has happened, right? The exact opposite happened, and those people now are in a bad situation because those condos that they were thinking possibly that they will assign out just to take the profit and then move on, well, that's not happening anymore. So just looking at today's report from Ontario Real Estate, we know that the condo market is about 30 to 40% down in values. The detached houses are about 20 to 25% down. So a lot of equity has been eroded, and people who borrowed have nowhere else to go at this point in time as to how to get out of it. And I was talking earlier about, before we started this conversation, that it's a vicious circle where you want to improve your credit, and the way to do that is to get some money from somewhere. And in order to get that, most of the times you need to go into your equity. And if you don't have that equity left anymore, you cannot borrow to improve your credit. So what I say to people, what I say to my clients is to start slow, and just keep doing the simple things, which means make sure that you are paying your minimum interest payments on a monthly basis, whatever is the frequency, and try to pay it a little bit before the payment date. Try to pay a little bit more than just the minimum payment. And also to try to do a lot of transactions still through a credit card, but try to pay it off as soon as you can. Because what it does is it builds the utilization, and then once you're paying it back, it reduces the utilization. So the number of transactions that you have on your credit and the number of times you pay it back, it starts building your credit score. And always try to have a lower amount of utilization on your credit, which again comes down to the situation of paying off your credit faster. So those are a couple of things that folks can do, but at the end of the day, you need to have to seek advice from a professional, whether you're looking at a consumer proposal, to look at a licensed trustee, or there are lots of people who are getting into bankruptcy these days because they just cannot take it. So deal with people who know what they're doing rather than just taking advice from somebody who's not a professional.
Great. And also a lot of people who are now coming in or who've recently come into the country, credit is more or less a new concept for us.
Yeah.
For us immigrants, we don't have the system back home. Now it started to come up in the last 5 to 7 years, but growing up, we've never seen it.
Right.
So if you had to sum it up for newcomers into the country, what are the top 3 things you can do to make sure you have a great credit going in?
Yeah, that's a very good thing, because you need to have good credit, especially in the North American countries, in order to get that lending, borrowing that you need. And in order to do that, credit is the key part. So the very first thing that I tell anybody who comes to me for any kind of advice on building credit is, first of all, try to get a secured credit card. Open an account with whichever bank you can and get into a secured credit card. $200, $300, $500, whatever is the limit you want to set. But open it up so that you start building that credit right away. And then once you start doing that, then apply for, Capital One is a great place to start with. Get a secured or an unsecured credit card. Small limits, $500, $1,000. Don't use your debit card. I know we try to use a lot of cash, especially in the South Asian side. And don't, initially, if you are building your credit, you need to use plastic. And you need to use those transactions in order to build your credit up. And be responsible. Just don't think that it's free money, because there's interest rate that's being charged on that. I try to let my clients know, don't get too much into points or rewards. Try to get the lowest interest rate credit card, because those points may seem to be really good, but they come with a higher interest rate as well. So initially building your credit, those couple of line items are good. So have at least one credit card or two. And then once you start building it up, through a line of credit and unsecured. So if you have 3 line items on your credit report, one revolving, a line of credit, and another credit card or two, that builds up a momentum for you, and then it helps you out when you're going in for a bigger lending like a mortgage or anything else, wherein the lender sees that you have credit, you have been responsible with it, you're paying it off on a timely manner, your utilization is very low, it should be lower than 50% majority of times, and that's a good way to start your credit journey.
Right. And why is now credit important from, let's say, a lender's standpoint when you're thinking of buying a house?
It's equally important, and more so simply because the lenders right now these days, they are getting at the end of the day, they are lending their money to us. So they need to make sure that their capital is safe. Of course, we'll be paying interest on it. And that's where the talk of having a good credit history comes into play, because the lender needs to know that if you're taking the biggest debt of your life, which will be mortgage, for example, that you have what it takes to pay off your current bills and the new exposure that you will have. Credit plays a bigger role, because then you know that what you're looking at is from the history, this person has paid off XYZ items, and this person's been responsible, and this person will obviously be able to make that next step as well, or transition towards a mortgage. So it plays a very big role. And what we also need to look at is what band you're in within credit. So for example, if you're going to the big 5, the Canadian chartered banks, or any of the A lenders that we call, or monoline lenders as well, they start with a credit score of 650 and above. So if your score is 650 and above, that's the first thing that will be needed to have your foot in the door to be eligible. So that's key, that you always maintain a score of 650 and above in order to give yourself that chance to get the best rate that a Canadian bank can provide you, and then go from there. And which is why having a good credit profile comes into the picture.
Right. We talked about debt, and I want to go back to, that demography out there of clients, of people who bought at the peak of the market in 2021 up until February of 2022. You spoke about condos, so let's talk about condos. The values have now dropped from the peak to about 25, 30, even more percent, depending on where we're looking within the GTA. Now, a lot of those people are finding it extremely hard to close on their properties, right? Our recommendation right now, I'm specifically asking people to try and close as if possible, of course,
right?
Because not closing has even harsher repercussions, right? Not only do people lose the deposit, they also get eligible, or not eligible, but responsible for whatever deficit is. So, for example, they bought a condo for $500K. Now the builder is selling it for $400. They get responsible for that $100,000 along with losing the deposit. Plus, if let's say they have a legal action against them, they get responsible for all the fees associated with
Absolutely.
that as well. Now, anything that those clients can do right now to close on the property that they purchased at the peak, which is now dropped significantly in value. Any suggestion for those clients specifically?
Yeah, absolutely. And this is, a situation that we are hearing more often, and it's going to keep happening for the next couple of years, because all of those condos, if you're talking about condos that were purchased during that time, are coming up for closing and occupancy. Some already have, and a lot of them are following suit. And I'll give you a perfect example. I closed in on a similar situation like that about a month ago. So I had a client who had purchased a condo. I believe the price that he got that point in time was about $850,000. Now that wasn't in GTA; it was in Ottawa. So that's why $850, because GTA market was totally bonkers at that time. When his time came for occupancy, which was supposed to be February of this year, he went back to his builder and asked, is there any room for some kind of rate drop? Because from what he was hearing, that the values have gone down to almost $650,000 or $700,000. So the builder said that, if you come through your lawyer, maybe we can look into some things. So he hired a lawyer, obviously paid the fees for that, and then they were able to negotiate a price drop. Now, I'm not saying that that can happen and will happen in all cases, but there's always that thing that you should try to do whatever you can first before looking into, okay, you can't close, right? So that was the first thing that this guy did. He sought help from a professional, legal professional, and they were able to bargain down or negotiate down the rate from 850 to 750. So the builder was really good because obviously they want to close out as well, but on the condition that the borrower will close in February. If they don't, then that rate goes up to 850. So then the client, he came to me from my known network, and then he said that, is there anything that we can do? So we looked at some of the options that were there, and based on the market research that was done, we found that the rate of those condos will probably be not even 750, maybe close to 650. So even if he was to close at 750, he would still need to, the mortgage would only be for 650, so he still has a deficit of 100,000. So there's this one thing that a lot of people don't know, and this is why you need to understand that when you go to a professional who has experience and knows what can be done and the options that can be provided. So what we looked at was we tried to see who was the bank that the builder was dealing with. So the bank was dealing with RBC. Now RBC, any of the big five banks usually are the back of the lending for these builders. So what usually happens from the experience that we've seen is that if you go back to that same bank for the mortgage of that borrower who will be purchasing that condo, majority of those times the banks, the blanket banks, so as to call it, they do not do an appraisal, or even if they do, they would provide an amount of close to or almost that purchase price amount, because they have their own share in that purchase.
Skin in the game. Yep.
Right? So they have skin in the game, so they want to close out as well. So we went to RBC, and RBC closed it at 750 for them. They did no appraisal for the guy. He was able to close it. We were able to save $100,000 for the client. He got a very good rate as well, and it was a happy situation. So those are some of the options that people can try before they just think that they cannot close out. Now that's part one of getting that closure. But let's just say if that thing doesn't happen, because majority of the time some people are not able to qualify for a specific lender because of whatever the situation and profile may be. So you need to get some money out in order to cover. And that's where you need to know as to how much equity you have in your own house, for example, or where else can you get that money from. What I try to do as well with my clients is I try to look at their equity if it's possible and trying to do a refi, so that we can get a refi, get that house closed. Once the house is closed, then I have certain strategies of my own that I work with my clients, knowing Smith's maneuver and cash flow damming. And through that, I show them the big picture that, just don't look at this transaction. Look at where you want to be in the next 10, 20, 30 years of your financial profile. And get this closing done, and then we'll move on to the next steps. We can talk about those at a later time, what those steps
for sure.
could be.
We will, 100%.
But that's the game. At the end of the day, you have to make sure that you close out, because not closing is obviously the last option, but then you're looking at legal proceedings, you're looking at more things, your deposit could be forfeited, so it will be more of a mess. So that's why speaking to a professional again is crucial to get to know the options you have.
Right. No, that's great. I'm sure a lot of people don't go down that route of contacting the developer and exploring their options.
Absolutely.
I know in some cases we've been able to get a VTB from the developers as well, right? So they close on whatever the appraisal value has come in from the lender, and the remaining amount goes as a vendor take back. So yes, it's a problem, but it's a much smaller problem as compared to not being able to close and losing all that money.
That's
plus
right.
legal costs.
Yep.
No, that's great. Thanks for sharing. So now, the new numbers, and we're sitting in May 2025, new numbers came in. Again, none of us, I think, have seen all the numbers yet and done our analysis, but we know that the inventory is now at a 16-year high.
Oh yeah.
Right, the prices are going down. How are the lenders reacting to this change? Do you see, because I was talking to one of my friends just this morning after the stats came out, and he mentioned he's feeling that the lenders are getting more tighter, more stricter in terms of approving people, especially on the B side of things.
Yeah.
A, not so much, but B side is getting far more stricter. So what do you think, or how do you think this change in inventory and interest rates and all the uncertainties impacting the lenders as far as their policies are concerned?
Right. And you know what? Since the start of this year, the one constant word has been uncertainty. And that's the only thing that has not changed.
Hasn't it been for the last 5 years? So that's how I feel.
Well,
Since COVID times, I don't remember, even a single year, let alone a single year, even a quarter,
Right.
where we haven't had something or the other going on that has instilled fear or brought about a certain degree of uncertainty.
Absolutely.
First, it was the craziness in the market because of the low interest rates and prices being too high. Then the interest rates were too high for too long. And then the banks in the US started crashing. And now we have Mr. Trump coming
Yes.
to power. I think you're absolutely right. Like, that's the only consistent
Exactly.
thing that we've had over the last few years.
Yeah, and I believe it's going to stay like that, till the time we have President Trump down south.
Feel free to share your personal comments about Mr. Trump.
I actually admire this guy, to be the devil's advocate. I think that he has a vision, and he sticks to his vision, and he doesn't care what anybody perceives of him. And he's almost 80 now, so nobody can change him.
Yeah.
But what I see is that there's lots of positives to take from a person like Trump, and of course there are lots of other things that I wouldn't go into at this point in time that we should not be looking at from a professional perspective. But I do believe that whatever is happening down south, it has a lot to do with whatever has and was happening within Canadian economy and politics as well. So I believe, in my opinion, that our own politicians have a lot of things to be mad about, and that is because of the lack of a backbone for our own politicians.
Right. And for a long time.
And for a long time, right? And what has happened in this scenario is that with President Trump coming into the mix, it has actually highlighted all of those shortcomings, those drawbacks that were there. And now you're looking like, okay, where do we hide? Because you cannot hide anymore. If you look at Alberta is already looking at, being the 51st state. They've already started the referendum. So not to go too much into the politics, which I would love to get in on a separate time. But I believe what we need to look at this point in time is, how do you get the best out of the situation? And how to get the best out of the situation is thinking that there is never a good time or bad time to do something. If we keep thinking that the rates will come down and then we will get into the market, then you will never be able to time the market the way you want to, because that may not happen. A lot of folks that I do talk in, on my social media channels, say, when is the right time to get in? And I'm like, any time is the right time. Any time is the right time. And that is because once you get in, you have to make it right. And you do that by knowing what you're getting into.
Right.
We have to keep an eye on that.
Absolutely. Absolutely. So based on what we're looking at right now, let's talk about variable first. So we do expect the variable to kind of go down a couple times at least within this year, hoping that, the overnight lending rate could be somewhere around 2.25%. That's at least, my guess based on the limited knowledge I have. But now there are different clients out there, different people, in different life situations. Somebody might be looking at buying a first home versus somebody their fifth investment property.
Right.
So how is your suggestion different for taking on a fixed versus a variable for a first-time buyer versus, let's say, a seasoned investor?
Right. So it depends upon the financial profile, to be honest, of the person. And that depends upon how much of a risk can they take, because getting into a variable mortgage, especially during an uncertain time, it can be fairly risky. We saw what happened in 21, 22, when the rates were zero, and then they spiked and they were historically high. And a lot of people lost a lot much in real estate. So you have to look at it from each person's scenario to see if there was a 2 to 3% increase in the rates over the course of the next 5 years, would they be able to handle that increase? So for example, if somebody is looking to purchase their own property, in that case, and if they're supposed to live in it, the first thing that somebody would want is certainty as far as their payments are concerned. So I would usually suggest them to fix their rate for a longer period, which would be 5 years, and go from there, knowing that this is the amount that they have to pay come what may, and be happy with that, and don't think what's going to happen in the future with the rates going up or down. Once you get the rate, lock it and done. But for people who are investing, now there's a little bit of leverage there. You know that you're investing, and if you're investing, then you need to understand that there has to be some kind of capital and cash flow that they will keep in order to make sure that they're looking into all of the pros and cons. In those cases, usually I do recommend a variable mortgage, and that is simply because you would assume that investor, in this case, will have a little bit of deeper pocket in order to ride the wave that may come through. And as a result of that, also because it's an investment property, there are things that you can write off. So you need to look at those things as well from a taxation perspective. So it depends from, I guess, person's situation. But if you're looking at investment side, going to a variable side would be something that would be better. And for a person going for their own house, usually staying fixed just because they can have their peace of mind, go from there.
Right, right. Also, I think to help the real estate market overall, we've seen a lot of new regulations come into play over the last, I think, 6 months or so, give or take. Now, we have 30-year amortization now for first-time buyers, whether you buy a resale or a pre-construction, irrespective. We've had insured mortgages go up from $1 million to $1.5 million. Now, in your opinion, do these new regulations in terms of 30-year amortization, insured mortgages going up, and some other things, do you think it will really help the market, or are these things even going to work in the long term?
Well, there's based on the data that we have, I believe from what we've seen so far is that those measures have not been able to assist those first-time home buyers or other buyers who were looking for insured mortgages to get into the real estate market, and that is simply because the cost to get in is still, even though it's coming down now, but at that point in time it was still higher. So people who are within their 30s and 40s, they need to have a bigger amount of down payment in order to get to their first purchase. Now, those measures of a 30-year amortization helps a little bit in order for you to get qualified, because then you're looking at a lower amount to qualify. Instead of a 25-year, you can take it up to 30, but then your interest cost increases over a period of time. So you need to keep that in mind. And that the $1.5 million insured mortgage instead of $1 million, all that really tells you is that you still have to qualify to get to 1.5 million. So in order to qualify for a house of 1.5 million, your household income should be close to 300,000. And you're talking about a first-time home buyer in this situation. So how many of people do we know in this scenario have that kind of a room? So these measures, even though they seem to be good on paper, but I haven't seen any kind of an impact of those things happening in the real estate market. What I do suggest to people is to stick with the normal scenario. The normal scenario is put in 20%, get a re-advanceable mortgage, and with a re-advanceable mortgage, you start thinking about paying down the mortgage instead of looking for a rate. So to my clients, what I talk about is don't look at a mortgage at just a rate, because if you're just rate shopping, then you will never be able to pay off that mortgage. You'll just be able to survive. And do you want to pay off the mortgage, or do you want to get into a mortgage? So those are the things that people need to look at. But the measures, I believe with the real estate economy, the way the values are coming down right now, that I mean, it's good and bad because it's good for people who want to get into the market, so they are coming in at a lower time and lower rate. But for people who are selling, the boomers, they are not going to get the value. So it just depends upon, which side of the real estate you are.
Right. You used the term re-advanceable mortgage. Can you explain what's the difference between, let's say, a traditional one and a re-advanceable?
Absolutely, and it's very important for folks to know. Re-advanceable mortgage is a fancy term for something that is as simple as a mortgage, which has a fixed rate term, and it has a home equity line of credit linked to it. So usually, what would happen is you would get a mortgage. And as and when you pay down the mortgage, you see the mortgage amount coming down, and you would see that in the statements or online banking. But you're unable to access that equity that's getting built as a result of paying down your mortgage. But through a re-advanceable mortgage, you have that mortgage at a fixed rate majority of the times. And as and when you pay it down, you see that equity building in the home equity line of credit. Now, that, of course, is at a variable rate, usually at prime plus 0.5%. So you kind of sometimes get best of both worlds, wherein you have a fixed rate amount and you have a variable rate amount as well that's coming in. So best of both worlds. And if you want to use it, you can certainly use it, and you don't have to do a refinance on your property to take care of that equity. So what I believe in is to utilize the equity and to leverage it if possible, obviously knowing the pros and cons and speaking to a professional about it. But a re-advanceable mortgage gives you a big step in actually working on paying down the mortgage, which is what the goal should be. And that starts with a 20% equity in your purchase. So if you're purchasing a new property, you should put in 20% down. Or if you're doing a refinance, then you should have at least 20% equity in your existing property. And credit score, again, is important. It should be 650 and above. If it is 700 and above, it makes things easier.
And now talking about the 1.2 million folks who are coming up for renewal this year and next, how soon should they start planning?
Right now.
Right now.
Right now. And the reason for that is because, I speak to a lot of people over social media and just, during network programs and whatnot. And that's the question that comes up is, when should I start shopping? And what about the rate? What rate should I get? And the question that I put them back is, what are you trying to do? Are you trying to get rid of the mortgage? And again, it's going to come back to the same thing. Or are you actually trying to get just into the next term? So if you're looking to get out of your mortgage and pay that off, then it's never a wrong time to start thinking about it right away. And no matter what the interest rates are now, if you get the right type of mortgage, not the right rate, if you get the right type of mortgage, you are always going to be able to work on things that can help you in paying off the mortgage. So my whole mantra is always that you should be looking at paying off the mortgage and not just getting into another term. And you can think about getting another mortgage that can help you do that at any point in time.
Right, right. Which also gives me a segue to ask the next question or get into the next segment, which is, I believe, a balance of consolidation, like paying your mortgage down, and expansion at the same time. If you are an investor, if you want to own, an investment portfolio, how do you best strike a balance between consolidation and expansion at the same time when it comes to your real estate portfolio?
And that's, that's more important any time than now, which is that a lot of folks have taken on a lot of debt. And that consolidation becomes key. But then that doesn't mean that you let your financial and personal goals be on the side and don't think about that. So there's three main things that any Canadian homeowner needs and wants. Number one is the mortgage that you have, to amortize it as soon as possible. Number two is to reduce your tax bill, your income tax bill. And number three is investment for your retirement. All those three goals are there for anybody who has a mortgage, who has kids, who's looking towards retirement. And we should never stop thinking about those at any point in time, no matter what the situation is. So what we're looking at is, I'll give you a perfect example. I got a client last year in February. And that was a time when the interest rates were at their peak. Now, this client of mine, he was pretty well off. He was making close to $190,000 household income. He had his own detached property, and he had 2 rentals. From the outside, if you look at it, this person is a perfect investor, doing really well, but still paycheck to paycheck, and actually bleeding because all of his mortgages were variable rate, because somebody told him, go variable, and he went variable on all of his mortgages, not knowing that the rates will spike. So he was basically bleeding financially. On the outside, he would look as a landlord collecting money, but he's out of pocket. So what does he do, and how does he get out of the situation where he needs to consolidate debt and still be that investor and fulfill his dream? So when he came to me, his mortgage on his own residence was in negative amortization by 58 years, because he wasn't even stop above the principal amount. He wasn't even paying enough money towards the interest. And he actually wanted to sell the rental properties because the interest rates had gone up, and the tenant said that they cannot pay any higher rent, so he couldn't increase the rent either. So he was in a jam, and he wanted to know what could he do. And he wanted me to actually refinance his mortgage on his principal residence so that he could consolidate debt and maybe get a lower rate and sell the 2 properties, because he just wasn't seeing any kind of future in that. So when I looked at his entire portfolio, one thing stood out, which was that he has put his hard-earned money into real estate. And that is something that I can save and show him the direction as a professional. So what I looked at is I was able to get him into a re-advanceable mortgage with Manulife One, and we can talk about it when we have some time. That mortgage set him up for future, and how we did that is his negative amortization of 57 years. Now, as of yesterday when I spoke with him, he's going to be done paying off his mortgage on his primary residence by 2029.
Amazing.
4 years from now. He gets to keep his rental properties. He has 2 sons. The vision was each son will get their own property. By the time they grow up, it will be paid off. The perfect dream for anybody. And he is able to achieve that dream because of the strategy, the Smith Maneuver cash flow damming strategy that I showed him, that even though he may be bleeding, he may be out of pocket, but look at 20, 30 years, your mortgage is getting paid off in 4 years, and outside of that, you will be able to build wealth from your properties. So I guess the future that we want to show within real estate world is that thing still works if you know as to what to do and how to deal with professionals who know what they're talking about and who can help them out to see the light at the end of the tunnel. Because a lot of people are in this shape right now, especially in the condo market, and you need to show them that they can keep it and they can still get out and be in a positive scenario.
Right. So you mentioned 2 strategies here. Now, this seems to be too good to be true. For somebody who was in a negative amortization for 57, 58 years, and now suddenly in 4 years they're, done paying off the mortgage on the primary residence. Take us through these strategies. How does the Smith Maneuver work? Right.
So, and you're right. It does sound too good to be true, but when you actually look at it on paper with the numbers based on your financial profile, you would basically say, fuck, why did I not look into this and talk about this 20 years back when I bought my first property? And that's the reaction that I get majority of the times, whosoever looks at it. So basically, it's a Canadian strategy that has been in existence since the late 1980s, which is called Smith Maneuver. It was implemented, and the person who came up with it, his name was Fraser Smith. And back in the late 1980s, early 1990s, it was a similar scenario like we're in right now. The economy was crashing, the interest rates were skyrocketing, the equity in the houses was plummeting. People did not have any way to service their mortgage, let alone reduce the amortization. There's no way to paying off, reducing their income tax, because for that you need to invest into RRSPs. TFSAs were not there, but so all those things were there. So when Fraser Smith, what he looked at was he looked at the U.S. Mortgages, and the mortgages in U.S. The primary residence mortgage, the mortgage interest is tax deductible. So he looked at it and he saw as to, okay, why is that same thing doesn't apply to Canadian mortgages? And it's just the way the Canadian income tax law and mortgage laws are. You cannot make the mortgage interest tax deductible on a principal residence mortgage. It is on the rental property, but not on the principal residence side. So he looked at a lot of mortgages and talked to a lot of banks, and he came up and he looked at this income tax law and a subsection 21C, which states that if you borrow funds to invest into an income generating instrument, the interest on that loan becomes tax deductible based on your marginal tax rate. So number one, you need to borrow. Number two, it needs to be borrowed and put into an income generating instrument. So that could be a rental property. It could be into any financial products like GICs, ETFs, mutual fund stocks, bonds, anything that's income generating. And that's a key part. That will create the interest on that will create tax deductions on your marginal tax rate. So I'll give you a perfect example. Let's just say you are at the maximum marginal tax rate of 53.5%. And you're borrowing from somewhere. People borrow a lot from their own equity, and they try to put a down payment towards a rental property from that equity. A lot of people have done that, but a lot of folks are not aware still that that down payment that they took out from their principal residence mortgage to invest into the rental property, that is now tax deductible. Based on your marginal tax rate. So let's just say if you took $200,000 out for $1 million property, the interest on that amount is tax deductible. So if it was 6% interest, $12,000 is your interest. And if your marginal tax rate is 53.5%, you're getting almost $7,000 back from CRA, right? So that is something that a lot of people are not aware of, and they don't exercise it. The accountants even are not aware of, because it's not a specific section within income tax that a lot of accountants deal with. So you need to have that professional know-how. And that's what the entire basis and crux of Smith Maneuver is. And the reason why it's called Smith Maneuver is because our mortgages are not interest tax deductible on primary residence. So the way it's maneuvered is through a re-advanceable mortgage, which has the mortgage portion, which is fixed rate, and the HELOC. So from the HELOC is where the borrowing is happening. So in that example of my client that I spoke with earlier with negative amortization, so we implemented two strategies for him. One of them was plain Jane within Smith Maneuver, and the other was cash flow damming. All parts of Smith Maneuver, but sub-strategies. So the cash flow damming, the simple aspect of that is that you have the wealth. We all are wealthy if we were going to look at it from a real estate point of view. It's just that we are not cycling the money properly. So for a rental property, let's just say, Shay, if you have a rental property, you get rent from your tenant. It comes into a checking account, and from that checking account, maybe you are servicing the mortgage and the property tax and other expenses for that same rental property. So money's coming in, money's going out. It's not doing anything for you except for servicing for that mortgage. But how do you become a winner wherein you are doing more with that money? So instead of running after the money, your money is making more money for you. So what you should do instead, and that's a free piece of advice that I'm giving you right now. So instead of keeping that money in the checking account, why don't you put it as a prepayment to your principal residence mortgage, right? Nobody thinks about it. It's a very simple fact. Put it there as a prepayment. We all know prepayments always go 100% to principal. There's no interest charge on it. That amount becomes available in the HELOC. And with the HELOC, now that money is there, you still need to pay the mortgage of that rental property. You move that money by borrowing it from the HELOC and put it back into that account where you borrowed it from, so that the mortgage for that rental property can come out. So what you've done is two things here by cycling the money properly. One, you've reduced the amortization, actually shredded the amortization on your principal residence mortgage. Think about it. If you're getting rent of $4,000, you're putting $4,000 prepayment on top of your regular mortgage payments. That's going to shred your amortization right away. Now that amount is in your HELOC. You borrow the money from the HELOC and you put it back into that rental account. Now, because you borrowed it for income generating instrument, that amount now becomes tax deductible as well. So what you're doing right now is through that tax strategy, you're creating more money for yourself. You're paying down your mortgage. You are still paying off the rental mortgage, and that amount is now becoming tax deductible. So that is reducing the mortgage down a lot. So what we always say is mortgage is a bad debt. It is a debt, but Canadians need to know what kind of debt to carry, because not all debt is bad debt. So mortgage, bad debt because it's used for personal consumption. HELOC, good debt because you can borrow it and then use it for income generation products. So that's the whole strategy and the way it works. It is a long-term strategy. You need to be patient and resilient with it, because nobody became wealthy in a day. Rome wasn't built in a day. So you need to give it time. But you know that during hard times, you can still do those things, which is pay down your mortgage faster, reduce your income tax bill, and grow your investments, doing all those three things without spending any new money from your pocket. And that's the key part, right? This client of mine is able to do all of those three things, pay off his mortgage within 5 years, and have a multi-million-dollar portfolio by the end of 25 years if he stays on the path. And he would definitely be creating legacy for generations to come. And the way to do that is by speaking with a professional who knows what kind of mortgage to provide and who knows how to implement those strategies for you.
Right, right. No, that's great. That was a lot to process.
Yes, it is.
Because we discussed like a number of strategies, at least two. But I think it's great. Not only does it answer my question in terms of, how to go about striking a balance between consolidation and expansion, but also I think you mentioned a couple great things, and I will reach out to you for discussing my portfolio after this as well. But not only is it helping me grow, invest more into real estate, which I am a strong proponent of. Of course, my opinion can be biased because I'm in the trades myself, but it also helps you save taxes at the end of the day.
Absolutely.
So again, more in your pocket, and more in your pocket from the investment side of it, because, we are in a very strong real estate market. We are in a minor dip, but real estate, works like that.
Yeah.
But yeah, you're absolutely right. I mean, it takes time for any investment to grow and for you to see the fruits from it.
Exactly.
So anybody who is a believer in investments, in real estate more so, and, is patient in terms of being a long-term investor, I think it's great to be looking into these strategies for sure.
Yeah, and you know what? The first thing that happens during the times which are uncertain, the first thing that we stop doing is paying ourselves, which is we stop prepayments into our mortgages if somebody was, because you don't have that disposable cash anymore, and you also stop investing for your future. And these strategies allow you to stay on course because you're not putting in any new money out of your own pocket. So you can still do whatever you want. And even though, because you may have a lower amount of disposable income left, you know that your money is still working for you.
Yeah.
Rather than you working for it all the time.
Right. For sure. For sure. I also want to kind of look into the future a little bit with you. It's not like I wouldn't be going into the politics of things, but the fact is I think politics impacts our industry a lot more than it does some of the other ones.
Absolutely.
It impacts everything, but our industry a little bit more so, because the fact is 36% of the economy is built in and around real estate.
Yeah.
Right? It could be mortgages, it could be contractors, it could be home inspectors,
a lot of tradespeople.
Exactly.
Yeah.
Who's related to real estate in direct or indirect way. Now, how do you see the next 2 to 4 years taking shape under the new leadership? Now we can go in any direction, let's start with perhaps interest rates and prices.
Yep.
Right? How do you see the next 2 to 4 years when it comes to interest rates and prices under the new leadership?
Right. What I see is there a lot of opportunity. And the reason I say that is because the new government, whenever a new government comes in, the mandate for them provided by the Canadians is that they want some kind of action to be taken. So you know that Mr. Mark Carney, our Prime Minister, he would be putting in measures in place to prop up the industry and to prop up the entire Canadian economy because it's in everybody's interest to see a change for the positive direction. Now, he's already made some kind of announcements, a little bit on the income tax side, a little bit on the HST side, being not to be charged for the, I guess, the new constructions, and I guess more to come. But what I can say for certain is that with the rates of real estate coming down, it also will bring in those people who possibly were on the sidelines waiting for something to happen. This could be that opportunity. Now, whenever there are times wherein things are going hard, there's always two kinds of people. One who take it as an opportunity and seizes that opportunity, and another person would be, I will take it safe, I'll just stay on the sidelines and I'll watch. Right? And there's nothing wrong with that. A lot of people have been watching for the last 2-3 years because of either the interest rates being high and waiting for them to come down, or real estate values being really high, waiting for them to come down. And right now I see a kind of good mix happening wherein the values are coming down. And the interest rates we know are kind of at a place wherein they may not go up for X amount of months in future. Now, we don't know what's going to happen with tariffs and everything else, but let's just keep those things in mind, that they can change at any point in time. But what I am going towards my clients and anybody who sees my opinion is basically that there's never been a better time to get into real estate market right now if you have been financially prudent, if you have been a good investor, and if you've managed your portfolio well. And if you are speaking with the right professionals. So as a realtor, you know what value you bring into your clients. And I know there's a glut of, self-employed people in the market with the realtors, with the mortgage agents, accountants, and everybody else. And that's where I guess the end customer, the borrower, common people like you and me, they need to find out the right kind of professional to deal with. And also once they do, they need to trust that professional. And I always tell my clients that, place your trust in me and you will see the value. I, as a professional, need to provide some kind of value to my clients. And that is the value that you and I bring in, wherein we see the market, we see the trends, we see the neighborhood, we see the comparisons, and based off that, we're able to make good decisions. So to answer your question, I believe if you are able to get the right professional, that professional can guide you no matter what kind of scenario happens in future. But right now it's a good mix to jump in from my perspective, because if you are an investor especially, there are deals to be made. You can negotiate a lot, and you can bring down the price, and you can get in. And the rates are something that will always be up and down. But the market that is getting to the lower point, there's good times to get into the market.
Right. No, I absolutely agree. And again, I think we are in a unique phase of the market where although the interest rates are coming down, the affordability is improving, the prices are also softening at the same time.
Yes.
It usually doesn't happen that way. 80% of the times the market behaves in a way which is what everybody says is when interest rates go down, prices go up, and vice versa is true as well.
Right.
But I think when we look at the last 2, 3, 4 recessions, that's when we see this pattern when the interest rates and prices are coming down at the same time.
True.
And those are the recessionary phases, and we're in one right now as we speak. But more importantly, I think when we reach to the bottom of the interest rate cycle, which in my opinion could anywhere be between, let's say, end of this year and Q1 next year.
Right.
I think the interest rates would be at the bottom for this cycle. That's when the prices take a significant jump in the upward direction.
Right, and you know what? From my perspective, based on what I'm looking at with the data coming in these days, it will take some time for the prices to go up. And when I'm saying prices, that means on the real estate side, not the interest rates. And the reason for that is these tariffs that are in place right now, especially on the auto industry sector and other sectors coming into play now, with the Hollywood also being entered into that. If you're making up north or wherever,
we weren't expecting that. At least I wasn't.
Right. You see, so you know what the agenda is from down south. The agenda is to bring whatever production is happening in Canada back to USA or anywhere else globally, and America is our biggest partner, and that's where we are getting hit the most. So what we need to do is look at as to how things are going to progress. So it will get far worse before it starts getting better. And because of the reduction in force that is already starting to happen in the auto sector and in the other sectors wherein companies are no longer hiring because they know what's coming up to cut down on their expenses, that there will be a lot less people who would be willing to purchase a house, which is the biggest expense, biggest kind of shopping in their cart. And that's where the prices will still continue to float down, even though the interest rates may be steady or come down a little bit. And that's where a person needs to keep an eye on as to, how is their job? How secure are they in their job? How secure are they in their business? And based on that, gauge that and make a decision based off that. And if the prices go up, then obviously you make a lot of money. I don't see that happening right away within the next year or so. With the interest rates, again, we talked about the Bank of Canada overnight lending rate, 2.75 right now, may come down to 2.50 in June and then 2.25 in July. But the fixed rates are a different animal at this point in time. They are trending a little bit up. So we need to know as to what rates are we talking about, because we always talk about when we say rates are coming down based on what Bank of Canada is doing. And that's a portion of our mortgages. So we need to see things holistically, because I do get calls from people wherein they say that, the rates have come down, but their mortgage payments are still the same. And within that, there's a lot to tell the client as to what kind of mortgage you have within variable. And are you on a fixed rate mortgage? Sometimes people don't even know. And that's where I guess the education from the professionals come into play. That's where you and I come into the picture, where from our experience, from our expertise, being in the industry for such a long period, that we educate, especially at this point in time, and we guide our clients that, they are ready for the next wave.
Great. I think this was amazing. I think we discussed a lot of different things, a lot of education here. Any last thoughts that you'd like to leave us with?
Well, I believe in brick and mortar. I believe in real estate. I always believe that, no matter what happens over a long period of time, there will always be, progression and growth to have, as long as you are diligent enough and you are looking at all the pros and cons. And if you're an investor, investing wisely. And if you are a buyer of your own house, not be emotionally attached to the sale. Because when you get emotionally attached, then you can make wrong decisions. So that's where a realtor like you, Shay, comes into play, where you guide them to make the right purchase for a property. And I come into play to cover the bases and get the mortgage and get the deal done.
Right. And to your point, as Mr. Robert Kiyosaki says, gold, silver, and real estate. God's money.
Exactly.
Over the long term, it's never hurting you. It's only going up.
Yeah, appreciation is the key.
Exactly. And how do people find you, Vicky?
People find me very personable, down to earth. How do people contact me? Okay.
Yes.
That's good. Thanks a lot. I get too much into my spiel there. So how do people contact me? So I have my own website, vickymortgages.com. So VICKY mortgages.com. My email address is vickymortgages@outlook.com. I am very active on TikTok these days.
Tell me about it.
So follow me on TikTok as well. My handle is @VickyMortgages. I'm not too active these days on Insta and Facebook. I've tuned more out to the TikTok version now. And it's a great medium, great social media channel to be connected to. And obviously, dealing with the realtor side is always better. But yeah, you guys can reach out to me through any of those mediums. And I'm just a call away. And I try to respond back within the next 30 minutes if a voicemail is left for me. So I'm big on client services. I believe that if somebody has contacted you or you've contacted them, it is key to either pick up and say I'll call you back, or if a voicemail is left, then to listen to it and respond back as soon as you can.
Perfect. Thank you again for doing this today.
Thanks a lot, buddy.
Appreciate it.
Thanks,
Appreciate
Shay.
it.